Good day, my dear students. This is your Professor Darwin Malazarte. In this video, I will discuss and explain the contents of this module on Chapter 1, titled Basic Concepts in Engineering Economics, which I had uploaded for your reference. I will explain only those contents which I believe you wanted me to explain. But before I do that, let us pray for guidance and help from our dear Supreme Sovereign, Holy God, our Father in heaven. Pray for just 1 minute. Okay? Now let us pray. Amen. Okay. As I have mentioned in my Google Stream message, this chapter contains the answers to your assignment number 1. Your answers to that assignment may not be exactly the same as what are in this chapter, but as long as your answer conveys similar idea, I will consider it correct. Also, note that this module will be my basis in checking your answers to the 2 tests that I will be giving you for this chapter in the next 2 meetings. So use and study this module when preparing for the tests. Okay? Now, for the overview of this chapter. This chapter discusses the following. Number 1, basic concepts, important definitions, and some introductory knowledge and information in engineering economics. Number 2, some basic concepts and definitions in cost and financial accounting. Number 3, some basic concepts, knowledge, information, and methods in estimating costs and benefits. For the learning outcomes, you should be able to 1. Discuss and explain the basic concepts, important terms, knowledge, and information in engineering economics, basic concepts in cost and financial accounting, and basic concepts and some methods in costs and benefits estimating. Number 2, you should be able to solve problems about estimating the costs and benefits of engineering projects using the methods discussed in this chapter. For the learning assessment, an identification type of test and a problem-solving type of test will be given. Okay, now for the main subject matter, section 1.1, important definitions. The first term, engineering economics. Now this is the title of this course, so it is very important that this term should be defined. Okay, engineering economics is a field of study that is primarily concerned with the methods and techniques for analyzing and evaluating the costs and benefits of engineering project alternatives for the purpose of determining the most economically viable alternative. There are two words in this definition which I have not included among the terms defined here that I will clarify. First is this word primarily. Why primarily? It is because in this field of study, there are other subject matters that need to be studied in order to be able to use correctly the methods and techniques for analyzing and evaluating the costs and benefits of engineering project alternatives. Second is this word alternatives. What are alternatives? In this context, alternatives mean the other proposed projects that have different designs and approaches. Project alternatives are necessary so that when an analyst selects one alternative over the others, the analyst can say with confidence that the alternative selected is the most economically viable because it has been compared to the other project alternatives. Okay, next term, engineering. As used in this term, engineering economics, this refers to those endeavors that involve the application of science in the design, development, production, and maintenance of machineries, structures, equipment, engineering products, systems, procedures, and processes. As you know, designing, developing, producing, and maintaining machineries, structures, etc. are the primary job of engineers. Okay. Next term, economics, as used in the above term, refers to the financial aspects or money aspects in engineering projects. Next term, costs, as used in the above definition, refer to the money spent in implementing a project and includes all the undesirable outcomes of the project. Next, benefits, as used in the above definition, refer to the money and all the good things that the project generates or creates. Next term, project, as used in the above definition, refers to a planned program of work or enterprise which is undertaken to generate benefits and which requires resources such as money, materials, workers, equipment, and time in order to accomplish the project as planned. Okay, next section, 1.2, some important reasons for studying engineering economics. Number 1, to learn how to determine the costs and benefits of engineering projects. Number 2, to learn how to compare and determine the most economically viable project alternative. Number 3, to learn how to determine the most efficient use of money and other resources. Next section, 1.3, common situations where engineering economic analysis methods are used. Number 1, in selecting between alternative designs of structure, machine, system, product, and the like during the engineering design process. Number 2, estimating and analyzing the economic consequences of instituting engineering improvements in an organization. Number 3, selecting among proposed projects under capital budget limitation. Capital refers to money that are invested in project particularly. Number 4, deliberating on replacing machineries, structures, equipment, system, and the like. Number 5, choosing between asset lease and purchase options. Lease here means rent. Okay, next section, section 1.4, important principles in engineering economic analysis. Okay, the first one, develop the alternatives because the choice should be among alternatives. One cannot say that an alternative is the most economically viable if that alternative was not compared to other alternatives. Number 2, focus on the differences in the estimated future outcomes of the criterion used by the alternatives, because only the differences are relevant to their comparisons. Now, this is because if there are no differences, there is nothing to compare, right? Number 3, use a consistent viewpoint. That is, consistently develop from a defined viewpoint the estimated outcomes of the alternatives. For example, if one alternative's profitability is analyzed from the viewpoint of the project's owner, then all the other alternatives' profitability must be analyzed from that same viewpoint. It is wrong to analyze the profitability of the various alternatives from different viewpoints. Viewpoints like the project's beneficiaries or users' viewpoints, the analyst's viewpoint, and other viewpoints. Number 4, a common unit of measure should be used in the analysis and comparisons of the estimated outcomes of the alternatives. For example, if the profit of one alternative is computed in Philippine pesos, then all the other alternatives' profits must be computed in the same currency. It is wrong to compute the profits of the various alternatives using different currencies. Currencies like dollars, pounds, euros, and others. Number 5, consider all relevant criteria because the selection of the preferred alternative requires the use of a criterion or criteria. The common relevant criteria used in economic analysis are profit, total cost, rate of return on investment, and benefit cost ratio. Number 6, risk and uncertainty are inherent in estimating the future outcomes of the alternatives and thus should be recognized and considered in the analysis and comparison. Risk and uncertainty are tackled in economic analysis using probabilities. But since this is the topic of Chapter 7, the last chapter in this course, I will talk more about these when I will discuss that Chapter 7. Next, principle number 7. Selection decision must be post-evaluated. The initial estimated outcome of the selected alternative should be compared with its actual outcome. This is necessary so that if there is a big difference between the initial and final outcomes, adjustments can be made to improve future analysis and the quality of decision making. And the last principle, number 8, monetary and non-monetary benefits must outweigh monetary and non-monetary costs. This is to ensure that the selected alternative is first and foremost economically viable. Okay, next section, section 1.5, examples of objectives in conducting engineering economic analysis. Number 1, profit maximization. Number 2, cost minimization. By the way, maximization is enlargement of profit. Minimization is reduction in cost. Okay, number 3, meeting client expectations. Number 4, maintain flexibility to meet changing demand. And number 5, maintain employees or workers' satisfaction. Now, these are just examples. Of course, there are other objectives depending on the company conducting the project evaluation. Next section, section 1.6, steps in conducting engineering economic analysis. The first step, define the objective of the economic analysis. Number 2, identify the economically viable alternatives that can accomplish the objective. Number 3, estimate the costs, benefits, and cash flows of each viable alternative. Number 4, choose the economic criterion to be used in comparing and selecting the best alternative. Number 5, compute and determine the result of the economic criterion in each alternative. Number 6, compare the economic criterion results of the alternatives and select the best alternative. Number 7, implement the selected alternative, monitor and do post-evaluation of the results. Okay, next section, section 1.7, the general categories of factors that are considered in economic analysis. I have 2 categories here. Number 1, the quantitative factors. These are factors which can be derived or expressed in monetary values. Examples are cost, benefits, revenue, profit, present value or worth, present worth, internal rate of return, economic life, payback period, volume of demand and supply. You will learn more about these factors in the next chapters. Okay, for qualitative factors, these are factors which cannot directly be derived or expressed in monetary values. Examples, quality of service or product, such as timeliness, speed of delivery, durability, reliability, safety, environment friendliness, aesthetics, and others. Another example, government laws that require observance of safety, environmental compliance, and social responsibility, and others. Another, management's preference or interest in a particular alternative. Another example, assessment on the availability of certain resources like power, water, labor. Another example, goodwill generated by an alternative for clients, customers, employees, etc. Next section, section 1.8, the basic concepts and definitions in cost accounting. Okay. Cost accounting is of particular importance in engineering economics because it is the source of many cost data and information needed in engineering economic analysis. Okay, some terms and concepts in cost and financial accounting that are frequently used in engineering economic analysis. First one here is cost. This is the money spent for doing something or the money paid for obtaining something. Capital. This is the money invested in a project for the purpose of producing or generating project benefits. Next term, the investment cost, sometimes called first cost, because this is the initial capital spent during the first year of the project's implementation and operation. Next term, material cost. This is the amount of money paid in obtaining the materials that are used in producing goods or providing services. Next term, labor cost. This is the amount of money paid for the services of people who are employed as workers for the production of goods or provision of services. Next term, the fixed cost. On a total basis, this is the cost that remains the same or constant regardless of changes in the volume of output or level of activity up to a defined maximum. On a per unit basis, this is the cost that varies inversely with the volume of output or level of activity. For example, on the total basis, let us consider the fixed cost attributed to the cost of operation and maintenance of a facility. If an existing facility has a capacity of producing a maximum of, say, 1,000 barrels of crude per day, then as long as the required volume of production is less than or equal to 1,000 barrels of crude per day, the fixed cost attributable to the operation and maintenance of the facility will remain the same or constant. But if the required volume of production is increased to, say, 2,000 barrels of crude per day, which will now require the purchase of one additional facility of the same capacity as the existing, then naturally the fixed cost attributable to the operation and maintenance of the two facilities will increase twofold. Now, on a per unit basis, the fixed cost per unit that is attributable to the cost of operation and maintenance of one or many facilities varies inversely with the volume of production, because the fixed cost per unit is computed by dividing the total fixed cost by the number of units produced. Okay. Other examples of fixed costs are interest paid for borrowed capital, insurance and taxes on production facilities, and administrative expenses. Okay, next term, variable cost. On a total basis, this is the cost that varies in direct proportion to the volume of output or level of activity. On a per unit basis, this is the cost that remains the same or constant regardless of changes in the volume of output or level of activity. For example, on the per unit basis, the variable cost per unit of, say, a product is calculated by determining the costs that are directly traceable to one unit of product. Once the variable costs per unit has been determined, the cost remains fixed and constant, whatever the volume or level of production. The variable cost per unit of a product will only change if the design of the product is changed, because then it will have new materials and processing requirements. On the total basis, the total variable cost is computed by multiplying the total number of units produced by the constant variable cost per unit. That is why the total variable cost varies in direct proportion to the volume of production. Examples of variable costs are direct material cost, direct labor cost, cost of supplies and utilities used directly in production activities. Okay, next term, overhead cost. This is a cost which cannot be directly traced to a product, a service, or any cost object under consideration. It is the cost of functions and things that support the production activities. It is also called indirect cost. Examples of overhead costs are salaries of management, purchasing expenses, computer expenses, insurance and taxes on land and buildings, electricity, water, and others. Next term, operating cost. This is a recurring periodic sum of costs for keeping the business going. This can be the sum of administrative, production, sales, engineering, and other departmental costs. Next term, maintenance cost. This is a recurring periodic cost for keeping the machineries, equipment, and facilities in good operating conditions. Next term, disposal cost. This is a non-recurring cost associated with the termination of operations and the disposal of assets. Next term, opportunity cost. This is the earnings that would have been obtained from an economically viable alternative investment or project had it been implemented and carried out. Next term, marginal cost. This is the cost of producing one more unit of product or of providing one more unit of service. Another term, total cost. This is the sum of all the costs categorized as fixed cost, variable cost, and overhead cost. This is the general formula. Total cost is equal to the fixed cost plus the variable cost plus the overhead cost. Another term, revenue. This is the amount of money received from the sale of goods or the provision of services. This is the general formula. Revenue is equal to the number of units sold or provided times the price per unit. Another term, profit. This is the excess of revenue over total cost. And this is the general formula. Profit is equal to revenue minus total cost. next term here, loss. This is the excess of total cost over revenue, and this is the general formula. Loss is equal to total cost minus the revenue. Okay, next section, section 1.9, basic concepts in financial statements. Financial statements are financial reports that a company periodically distributes to its owner or owners or stockholders, if it's a corporation, to its management and its creditors, to provide information about the firm's financial condition and earnings performance over a stated period of time. Okay, this definition is taken from the reference book by Garrison and Nurin. Okay, financial statements are important in engineering economics because they are one of the sources of data and information needed in engineering economic analysis. But you will not study on how to prepare financial statements, because it is enough that you will know the concepts, elements, and the items included in financial statements. Now, the first of the financial statements that I will discuss is the balance sheet, also referred to as statement of financial position. This is a financial statement that summarizes the assets, liabilities, and owner's equity of a company for a stated period of time. Owner's equity is also referred to as shareholders' equity, stockholders' equity, and net worth. Now, the balance sheet format is defined by the fundamental accounting equation, which is as follows. Assets is equal to the sum of the liabilities and owner's equity, where assets are the things of monetary value that the company possesses. Liabilities are the things of monetary value that a company owes. And owner's equity is the amount of what a company owes to its owners or stockholders. Now, this is an example of a balance sheet. This is taken from the reference book by Blank and Tarkin. Okay. A balance sheet is prepared usually annually, every year. Now, this example balance sheet is for the period ending May 31, 2012. Now, in this sample balance sheet, we have here two columns, one for the assets and one for the liabilities and net worth. Okay. Under the assets column are, in this sample balance sheet, are two kinds of assets: the current assets and the fixed assets. Now, the usual items under the current assets are these: cash, accounts receivable, which might be the sales that are not yet received, no? The sales from the products that are not yet received, and then the interest accrued receivable, which um, could be the interest earnings of the company's investments in other companies. And then the inventories, no? Inventories of all the assets, including the goods. Okay. And in this sample, you have, this is the total current assets. Now, for the fixed assets, these are the usual items included. Okay, land, building, and equipment. But the building and equipment has to be deducted by their depreciations. Okay. I will talk about depreciation in chapter 5, I think. Okay, and so the total of these, this is the total fixed assets, and the sum of the current assets and the fixed assets is the total assets. Okay. Now, under the liabilities, these are the usual items. No? Accounts payable. This could be the amounts that are to be paid to the company's suppliers. And then next, the dividends payable. These are the amounts that are to be paid by the company to its investors. Okay, and the next, the long-term notes payable. This could be the amount that are to be paid by the company to also to its investors using long-term notes. And the bonds payable are also the amounts to be paid by the company to its investors that uses bonds, no, in investing. And this is the total liabilities. Under the net worth, these are the usual items. The common stock, this is the amount that the company or corporation, in this case, owes to its common stockholders. Okay, the preferred stock, this is the amount of the stocks that the corporation owed, the amount of the stocks that the corporation owed to its preferred stockholders. And the retained earnings. Retained earnings are the excess, no, after deducting the profit with by the dividends paid to the investors. And the retained earnings are kept by the company or corporation. They are reinvested, no, into the company for business expansion or for investing in other projects. Okay, and this is the total net worth. The sum of the total liabilities and the total net worth is this. And take note that the sum of the liabilities and net worth should be equal to the total assets. Okay. Now, next, financial statement, called the income statement. This is also referred to as profit or loss statement. This is a financial statement that summarizes the revenues and expenses of a company for a stated period of time. It provides information about the amount of net income or profit earned or of net loss incurred by a company during a stated period of time. Now, this is an example of an income statement. This is taken from the reference book by Blank and Tarkin. Okay, the income statements are also prepared annually. Now, in this sample, this is for the year ended May 31, 2012. These are the usual items included in an income statement. No? You have the revenue items and the expenses items. Under the revenues, these are the usual items, sales and the interest revenue. This might be the interest earnings of the corporation's investments in other companies, okay, and the total revenues. Now, under the expenses, these are the usual items, the cost of goods sold, okay. By the way, cost of goods sold is the cost incurred in producing the goods that are sold during a stated period. Okay. Another item, the selling expenses, expenses associated in selling the goods, no, that includes advertising, transportation, and so on, and others. Next item, administrative, the administrative expenses. This includes the salaries of the management and other expenses. And this is the total expenses. These are the total expenses. And then when the total revenues are deducted by the total expenses, you have what we call the income before taxes, because a tax has to be deducted from this, kaya income before taxes. And the taxes are usually in percentage, no, required by the government, the local government. Now, for this case, this is 45% of the income before taxes. After deducting the taxes for the year from this income before taxes amount, you have the net profit after taxes. Okay. Now, another financial statement called the cost of goods sold statement. This is a financial statement that gives details about the costs incurred in producing the goods that are sold during a stated period. Okay, example of a cost of goods sold statement. This is an example. This is taken from the reference book by Blank and Tarkin. Okay, these are the standard items included in this cost of goods sold statement. You have the materials or direct materials, the direct labor, and the indirect costs. Okay. Under the materials are these items. Okay. The inventory of the materials at the beginning of the year. By the way, this cost of goods sold statement is also prepared usually every year, no, annually. this sample cost of goods sold statement is for the year ended May 31, 2012. Okay, so the inventory here is for the inventory of materials at the beginning of that year, that year considered. And then another item are the purchases of materials during the year. Okay, and then the total of these two will be deducted by the inventory of materials at the end of the year. Okay, and difference is the cost of materials or direct materials. And then you have the direct labor, and then the sum of the direct materials or the cost of materials and the direct labor is what we call the prime cost. Sum of the direct materials and the direct labor is the prime cost. And then the indirect cost, and the sum of the prime cost and the indirect cost is what we call the excuse me, factory cost. Okay, and then the factory cost less the increase in finished goods inventory during the year, finished goods, not materials. The difference is the cost of goods sold. Okay, if you will notice, if you have noticed, the cost of goods sold is an expense item in the income statement here. Okay, so that's all for now. For the other sections in this chapter, please open the other video record.